Most traders chase breakouts and wonder why they get trapped. The professionals, they're buying at the last point of support while the crowd panics. This is where the composite operator completes their accumulation before markup begins. Master this single entry point, and you'll stop buying tops and start entering where smart money builds their positions right before the real move unfolds. For example, picture this. After a spring shakes out weak holders, price returns to test support one final time. Volume contracts. The selling pressure exhausts. This is your last point of support, the final opportunity before the campaign begins. While amateurs wait for confirmation at higher prices, you're already positioned with the operators. Now let me explain to you one of the most critical junctures in the entire market campaign, the last point of support. If you can learn to recognize this point with accuracy, you will possess a distinct advantage over the uninformed speculator who buys at the wrong time and wonders why the market immediately turns against him. The last point of support does not appear randomly. It emerges only after a specific sequence of events has unfolded within the trading range. You must first understand that accumulation follows a logical progression. It is a campaign, carefully orchestrated by the composite operator to transfer stock from weak hands to strong hands without driving prices higher prematurely. Here is how the structure develops. After an extended decline, price enters a trading range where preliminary support appears. The selling climax exhausts the majority of panic selling, followed by an automatic rally as short covering and bargain hunting lift prices. But the campaign is far from complete. The composite operator requires more stock, and he must test the market to determine how much supply remains. This brings us to the secondary test, where price returns toward the selling climax low. If this test occurs on reduced volume and narrower spreads, it tells us something vital: supply has diminished. The sellers who were so eager to liquidate at the climax are no longer pressing their offerings. This is your first clue that the balance is shifting. But the composite operator is thorough. He often engineers a spring, a deliberate move below the apparent support level designed to trigger stop-loss orders and shake out the remaining weak holders who bought prematurely. This spring is the final cleansing action. It creates fear, induces selling, and allows the operator to absorb the last available supply at favorable prices. Now observe carefully what happens next. After the spring, price rallies back into the trading range, often producing what we call a sign of strength, a widespread, higher volume advance that breaks through resistance. This confirms that the character of the market has changed. Demand is now overwhelming supply. Following this sign of strength, there comes a natural reaction, a pullback. The market cannot advance in a straight line. It must pause, consolidate, and prepare for the next phase. This reaction brings price back to support one final time, and this is your last point of support. At the LPS, you will observe distinct characteristics: volume contracts sharply, showing that sellers are exhausted. The price spread narrows, indicating that there is no longer any urgency to sell. The decline halts quickly and reverses, demonstrating that demand is present and accumulating any supply that appears. This is not merely another support test, it is the last opportunity before the markup campaign begins in earnest. The composite operator has completed his accumulation. The stock is now in strong hands. The next significant move will be upward, and those who position themselves at the last point of support will profit handsomely while the crowd chases prices higher, buying at inferior levels. Study your charts. Learn to recognize this structure. The market reveals its intention to those who know how to read it. Let me direct your attention to the specific characteristics you must observe to distinguish a genuine last point of support from an ordinary reaction. This is where the art of tape reading and chart analysis becomes invaluable. You cannot rely on hope or guesswork. You must learn to read what the market is actually telling you through its price and volume behavior. First and foremost, observe the volume. This is your window into the supply and demand equation. At the last point of support, volume must contract significantly compared to previous tests of support. Why is this crucial? Because diminishing volume on a decline to support tells you that sellers have lost their enthusiasm. They are no longer eager to press their offerings. The supply that was so abundant during the selling climax, and even during earlier tests, has now been absorbed. Compare this carefully with the volume that accompanied the spring or the initial decline into the trading range. You will notice a marked difference. Where there was once heavy volume indicating abundant supply meeting strong demand, you now see tepid volume, perhaps only 1/3 or 1/2 of the previous levels. This contraction is not accidental. It represents the exhaustion of selling pressure. Now examine the price spreads, the distance between the high and low of each bar or session. At a true last point of support, you will observe narrow spreads. The price may drift down toward support, but it does not plunge dramatically. There is no urgency, no panic, no wide-ranging bars that indicate aggressive selling. Instead, you see tight, compressed price action that suggests the market is in equilibrium at these levels, with very little stock changing hands. Pay particular attention to how quickly price recovers from the LPs. This is perhaps the most revealing characteristic of all. If demand is truly in control, if the composite operator has indeed completed his accumulation, then any decline to support will be met immediately with buying interest. The market will not linger at support. It will not make multiple attempts to break lower. Instead, it will rally smartly, often closing in the upper portion of the day's range or near the high. This ease of advance from the support level demonstrates what I call hidden demand. While there may not be dramatic volume on the recovery initially because the operator is not yet ready to reveal his full hand, the price action itself shows strength. It lifts readily. It does not labor or struggle. This tells you that there are no serious sellers opposing the advance and that buying power stands ready beneath the market. I want you to understand something critical. Volume tells you what is happening, but price action tells you who is winning the battle. When you see diminishing volume on the test of support coupled with a quick, effortless recovery, you are witnessing the signature of professional accumulation. The supply has been exhausted. The weak holders have been eliminated. The stock is now in strong hands. Contrast this with a failed support test where volume increases as price declines. This reveals renewed supply, a danger signal. Or consider when price spreads widen downward with heavy volume. This indicates weakness, not strength. These are the characteristics of distribution, not accumulation. Train your eye to recognize these subtle but critical differences. The market speaks through its volume and price behavior. Learn its language, and you will know when the last point of support is genuine and when the markup campaign is about to begin. Now, I want you to consider the strategic position you occupy when you enter at the last point of support, compared to the unfortunate speculator who waits for what he calls confirmation and buys after the breakout has already occurred. The difference in outcomes can be substantial, and understanding this difference will transform your approach to market operations. US. Begin with the matter of risk. When you purchase at the last point of support, you are entering at the very point where the composite operator has just completed his accumulation campaign. Your risk is clearly defined and minimal. You can place your protective stop-loss order just beneath the spring low, the lowest point of the entire trading range. This distance may represent only 2, 3, or perhaps 5 points of risk, depending on the stock and the size of the structure. Now consider the trader who waits for the breakout above resistance. By the time he receives his confirmation, price may already be 10, 15, or 20 points higher than your entry. He convinces himself he is being prudent, waiting for proof that the advance has begun. But what has he actually accomplished? He has dramatically increased his risk while simultaneously reducing his potential reward. His stop must still go below the trading range, yet he is entering at a far less favorable price. This brings us to the question of reward potential. The entire markup campaign lies ahead of you when you enter at the last point of support. Every point of the advance from the top of the trading range to the ultimate objective of the move represents profit for you. You are positioned alongside the professional interests, the composite operator himself, who has spent weeks or months accumulating his line of stock at these favorable prices. Calculate your risk-reward ratio carefully. If your risk is 3 points and the projected advance based on the cause built in the trading range is 30 points, you have a 10-to-1 opportunity. This is not gambling, this is intelligent speculation based on reading the market's message correctly. Even if only half of your positions work out as planned, you will profit handsomely because your winners far exceed your losers. But there is another advantage, perhaps less obvious but equally important, the psychological advantage. When you enter at the last point of support, and the market immediately begins to advance, you gain confidence in your analysis. You are not underwater from the start. You are not hoping and praying for the market to come back to your entry price. Instead, you are in profit almost immediately, which allows you to hold your position with conviction as the markup unfolds. The late buyer, by contrast, often experiences immediate anxiety. The stock may pause or react after his purchase, and he begins to question his decision. He lacks the structural understanding of where he stands in the campaign, and this ignorance breeds fear. Fear leads to premature selling, often at the very moment when he should be holding or adding to his position. Furthermore, by entering at the LPS, you have time on your side. You are not forced to act quickly or make hasty decisions. You can add to your position on strength, pyramid intelligently as the markup progresses, and you maintain a comfortable margin of safety throughout the campaign. Compare this to the speculator who chases the breakout. He is already behind. He has paid a premium for his confirmation. And now he must hope the advance continues without significant interruption. One meaningful pullback may take him below his entry price, triggering his stop and removing him from what may ultimately prove to be a successful campaign. This, then, is the strategic advantage: minimal risk, maximum reward potential, psychological confidence, and alignment with the professional operators who control the market's direction. Position yourself wisely, and the market will reward your patience and understanding. I must now introduce you to one of the most fundamental principles of market behavioral law, as reliable as any law of physics, the law of cause and effect. If you grasp this principle thoroughly, you will never again wonder whether a trading range is worth your attention or whether the subsequent advance will justify your entry at the last point of support. Here is the principle stated plainly: every effect must have an adequate cause. In market terms, this means that the extent of a vertical advance or decline of the effect is directly proportionate to the horizontal accumulation or distribution that preceded the cause. You cannot expect a significant markup campaign from a shallow, brief trading range any more than you can expect a mighty oak to spring from a seed planted yesterday. The accumulation phase is where cause is built. Each day that price remains within the trading range, oscillating between support and resistance while the composite operator absorbs the floating supply, adds to the potential cause. The longer the accumulation continues, the wider the trading range, and the more stock that changes hands from weak holders to strong hands, the greater the cause that is being constructed. Now, how do we measure this cause? This is not guesswork or estimation. We have a precise method. Using the point and figure chart, you can count the number of columns within the trading range to determine the potential extent of the advance. Each column in your count represents activity, back and forth movement that indicates absorption of supply and accumulation of stock. Let me give you a practical example. Suppose you have identified a trading range that spans 20 points in width and has persisted for 8 weeks. Your point and figure count reveals 30 columns of activity within this structure. Using the standard counting method, and this requires study and practice on your part, you might determine that this accumulation has built sufficient cause for a 40 to 50 point advance once markup begins. This knowledge is invaluable for several reasons. First, it tells you whether the opportunity justifies your capital and attention. A trading range that projects only a 10-point advance may not warrant your involvement, particularly if you must risk 5 points to participate. The reward does not justify the risk, but a structure. Projecting a 50-point advance with only 3 points of risk, this demands your serious consideration. Second, understanding the cause and effect relationship allows you to hold your position with confidence once you enter at the last point of support. When the inevitable reactions occur during markup, and they will occur, As the market never moves in a straight line, you will not be shaken out prematurely. You know the campaign has only just begun. You know the cause built is sufficient to carry prices much higher. This knowledge fortifies your conviction. Third, and perhaps most importantly, it prevents you from expecting too much from insufficient cause. I have observed countless traders enter what appears to be an accumulation pattern, only to find themselves disappointed when the subsequent advance peters out after a modest gain. Why? Because they failed to measure the cause. They assumed every trading range would produce a significant advance. The market does not work this way. A brief consolidation after a decline may produce only a rally back to previous resistance levels, what we call a distribution point. This is not a markup campaign. It is merely a temporary interruption in the downtrend, but a sustained accumulation with substantial cause built over weeks or months. This can produce an advance that exceeds your most optimistic projections. You must also understand that the composite operator himself is governed by this law. He cannot create a significant advance without first building adequate cause. He must accumulate a sufficient line of stock to control the supply and support the price as it rises. This takes time, and this activity creates the horizontal price movement we measure as cause. Therefore, when you identify the last point of support within a trading range, immediately assess the cause that has been built. Is it adequate for the campaign you envision? Have sufficient columns accumulated on your point and figure chart? Has enough time elapsed for the operator to complete his work? If the answer is yes, you may proceed with confidence. The effect the markup campaign will be proportionate to the cause that preceded it, and you, positioned at the last point of support with minimal risk and maximum potential, will profit accordingly. I must now caution you about a critical error that traps many students of market behavior, the mistake of confusing an ordinary support test with the genuine last point of support. Not every reaction to support represents the final opportunity before markup. Some tests fail, and if you enter prematurely on a false signal, you will find yourself holding a losing position while the market continues to deteriorate. Learn to distinguish the true from the false, and you will save yourself considerable capital and frustration. Let me describe the characteristics of a failed last point of support so you can recognize danger when it appears. First, observe the volume carefully. If volume increases materially as price tests support, you are witnessing renewed supply entering the market. This is the opposite of what should occur at a genuine LPs. Someone, and likely someone with substantial holdings, is using the support level as an opportunity to distribute stock. The composite operator has not completed his accumulation. Indeed, he may be doing the reverse, selling into the support test. This increased volume tells you that the balance between supply and demand has not shifted in favor of demand. The sellers are still present, still eager, still pressing their offerings. Under such conditions, you cannot expect the support level to hold indefinitely. It is only a matter of time before the weight of this supply overwhelms the buying and prices break lower. Next, examine the price spreads. At a failed support test, you will often observe wide-ranging downward movements bars that extend well toward the lower boundary of the trading range or even below it, with closes near the lows. This behavior indicates weakness, not strength. It shows that there is no significant demand stepping in to support prices at these levels. The market is laboring, struggling, unable to recover with any degree of conviction. Now consider the pattern of multiple retests. A genuine last point of support occurs once, perhaps twice at most, before the markup campaign begins. But if you observe price returning to support repeatedly, making 3, 4, or 5 attempts to hold that level without any meaningful progress upward, you are witnessing an ominous sign. This persistent testing reveals that demand is insufficient to absorb the supply and propel prices higher. The market is telling you that it is not ready to advance. Here is your critical confirmation signal. After a true last point of support, you must see a sign of strength emerge. This sign of strength is characterized by a widespread upward movement on expanding volume that carries price through the resistance level at the top of the trading range. This is the composite operator revealing his hand, demonstrating that he now controls enough stock to support an advance and that he is prepared to begin the markup campaign. Without this sign of strength following your presumed LPs, You have no confirmation that accumulation has been completed. You are operating on hope rather than evidence. And hope, as I've told my students countless times, is not a strategy in market operation. Let me give you a practical rule. If your supposed last point of support does not lead to a sign of strength within a reasonable time frame, typically 1 to 3 weeks, then it was not the true LPs. The market has told you that conditions are not yet right for advancement. Do not argue with the market. Do not rationalize or make excuses. Simply acknowledge that your analysis was premature and wait for clearer signals. I have seen traders convince themselves that every support test is the final opportunity before the big move. They enter position after position, each time believing they have identified the last point of support, and each time finding themselves stopped out as the market fails to advance. This is expensive education. Instead, be patient. Be selective. Wait for the complete pattern to develop, the spring or shake out, the sign of strength, and then the reaction back to support on diminished volume with narrow spreads and quick recovery. Only when these elements align should you commit your capital. Remember, the true last point of support validates itself through subsequent price action. The sign of strength that follows confirms you were correct. The ease with which price then advances confirms that the composite operator is indeed conducting a markup campaign. Your entry position will show you a profit almost immediately, and this profit will grow as the campaign unfolds. But if the market fails to confirm your analysis, if no sign of strength emerges, if volume increases on support tests, if multiple retests occur without progress, then you must have the discipline to admit you were wrong and preserve your capital for the genuine opportunity that will eventually present itself. The market always provides another chance to those who read it correctly and act with patience and precision. Now you possess the knowledge that separates the professional operator from the uninformed speculator. The last point of support is not merely a technical pattern on a chart. It is the culmination of a complete market campaign, the final opportunity before the composite operator begins his markup in earnest. Let me summarize what you must remember. The LPs appears only after a logical sequence of accumulation events, the selling climax, the automatic rally, secondary tests, the spring, and the sign of strength. It reveals itself through specific characteristics that cannot be faked: diminishing volume, narrow price spreads, and quick recovery demonstrating hidden demand. These are not arbitrary signals. They are the fingerprints of professional accumulation. When you enter at this point, you align yourself with the strongest hands in the market. Your risk is minimal, clearly defined by the spring low beneath you. Your reward potential is maximum. The entire markup campaign lies ahead. You possess a 10-to-1, even 20-to-1 advantage over those who wait for confirmation and buy at inferior prices after the breakout. But you must apply discipline. Measure the cause before expecting the effect. A shallow trading range cannot produce a sustained advance any more than a weak foundation can support a tall building. Count your point and figure columns. Ensure adequate cause has been built to justify your expectations and your risk. And exercise discrimination. Not every support test is the last point of support. Wait for the complete pattern. Demand the sign of strength that validates your analysis. If the market fails to confirm, if volume increases on tests, if multiple retests occur without progress, then you must have the courage to stand aside and wait for genuine opportunity. The market operates according to immutable laws. It cannot advance without first building cause through accumulation. It cannot absorb supply without revealing evidence in volume and price behavior. And it cannot begin a markup campaign without first establishing the last point of support, that final gathering point where professional interests complete their preparations. Your task now is clear. Study these principles until they become second nature. Practice identifying accumulation structures on your charts. Train your eye to recognize the volume and price characteristics that distinguish true LPs from false signals. Develop the patience to wait for the complete pattern before committing your capital. The market rewards those who understand its language and act upon that understanding with precision and discipline. The last point of support is where fortunes are, built not in the hope and guesswork of chasing breakouts, but in the intelligent, calculated positioning alongside the very operators who control market direction. Position yourself wisely. The opportunity will present itself, and when it does, you will recognize it, you will act upon it, and you will profit accordingly. This is not speculation, this is scientific market analysis applied with skill and discipline. Master it, and the market will reveal its intentions to you long before they become obvious to the crowd. Now go forth and apply these principles. Study diligently, observe carefully, and above all, let the market itself teach you through its price and volume behavior. Success awaits those who learn to read what is written plainly before them